Good afternoon, everyone. Good afternoon, everyone. I want to start by thanking you for joining us for this afternoon's, I guess it's second quarter outlook, Jason. Um, it's rather ominous, our picture here. I think, it kind of fits well with what's been going on over the last month or so. And, I think it also, our title, Reality Bites, a little bit more caution, also, fits well. What we're going to do is take you through kind of where we started, where we're at, and where we're going. And just as we go in here, you see the disclaimer. And by the way, we'll be sending out copies of the slides to everybody along with the recording. If anybody has any questions that we don't answer on the call, feel free to email us, all that kind of stuff. But don't worry if we go too fast through the slide or not. Okay, let's start it off. I think before we can talk about where we're at and where we're heading, Jason, you agree we should probably review the key points that we laid out in 2026 outlook call in January. And just for those of you that may not have caught the call or forgot what we had mentioned, we were talking about the bull market continuing, a lot of it driven by AI and an uptick in the earnings cycle. Valuations we acknowledge were high, which would also lead to a certain amount of volatility. And, that we had the Fed, so to speak, wind in our sails with expectation of rate cuts, along with the tax cuts that benefited various entities, including lower income consumers. And we'll touch on the K-shaped economy and just how some of the recent events may be affecting things as well. But I think, again, the key emphasis here is we're probably in the late cycle of a bull market. There's going to be more volatility. We're also in the midterm year, which also brings its own volatile back and forth. But let's get into the next slide here, because I think, Jason, do you want to jump in here in terms of we're I kind of talked about what we're talking about in January, but what's happened over the last 3 months?
Yeah, it's been, well, it feels like almost a year's worth of news in the first 3 months of the year. First start of the year, we had quite a number of headlines around Venezuela, Greenland, obviously what's the terrible issue that's happening in Iran. We also had the Trump attacking the Federal Reserve, which created volatility around, is the Fed independent? And then we moved into February. We saw more escalation in the Middle East. We saw Anthropic Claude code released, which caused quite a disruption in particularly the software sector, but it also had ripple effects across other parts of the market in real estate. And we started to see private credit funds gaining a lot of their products in the United States. Some of that concern is around the lending made to software companies. And so there's been quite a bit of turmoil year to date. Markets surprisingly have held up relatively well, and we'll
Yeah.
kind of get
And
into
Jason, just to add
filings.
in this, and we're not going to rehash the whole thing, but I would suggest asking for our last couple of newsletters, because we do touch on it in more detail around the software. But I think the private credit thing that's been a slow moving thing, would you say, in terms of kind of going from page 13 to front page. Here in Canada, we're hearing another firm in town now gaining their funds, well-known firm. Do you think that's going to be something that's going to be showing up here a little bit more
Well,
this year?
private credit in the States, I think, is about 2 trillion in lending. So will it become a systemic issue with broader implications to the rest of the market? I don't think unless, we see a severe recession in the States. But I think it's clearly going to impact investors who are invested in those funds and can't get their money out. And we need to kind of continue to be watching that to see if there's ripple effects that are spreading across the broader economy. But we haven't seen it show up in traditional bond markets yet. So I think that's a positive. And the function of gating basically keeps your money invested. So these private credit funds aren't forced to sell assets. So in a way, it's kind of it's good for the broader economy, but not good for the people that are tied up in the private credit
Yeah,
funds.
I had a chuckle. I won't say the firm, but there's a well-known firm in town. When I asked them about their gating, they said, "Oh no, we're not gating anything. We're just managing withdrawals."
Right.
Anyways, sorry, I'll let you go on to, SCOTUS striking down tariffs. I mean, that was
Yeah.
a big one last year, the whole tariff thing this time.
Yeah,
Now
the tariffs, obviously, the Trump administration kind of saw the writing on the wall, so they're pretty well prepared for the tariffs being struck down, and they're using other parts of the law to put the new tariffs in place. Effectively, what it's done from before the ruling and after, the tariff rate is about pretty much the same of where it was before the ruling. So maybe a little bit, about a 1% lower than it was before the ruling. So not really a big change there. I think there's uncertainty around how much money will be refunded, um, potential impacts on what that means for the deficits and national debt. But those are kind of longer term issues that will hopefully get sorted out.
yeah,
And then obviously the escalation of what's going on in the Middle East, which has created quite a bit of volatility for equity markets and upside volatility for energy shares. But kind of
yeah,
broadly looking at economic data, for the most part, it's been coming in line with expectations. The one kind of thing that we're concerned about is we're starting to see um, inflationary numbers coming in a little hotter than expected. Not so much showing in CPI yet. That could probably come later this year. But the preferred measure that the Federal Reserve likes to look at, the PCE, has been coming in a little bit hotter than expected, and that could be because of the tariffs, could be because of other factors, but it's something that's um, put one of the pillars for the bull market this year on a bit of a yellow flag.
and then just to add why like this is important, at least from our perspective, is when rates are going down, generally that's a win in the sales for markets. The fact that the Fed is now in the United States has moved to a neutral position on whether they're going to cut rates or not, it's something that, again, that is meaningful. We'll talk about Canada a little bit later on. Just so everybody knows, this was actually all done. This whole presentation was done on Monday. And so we filled in the April thing. I guess it was yesterday after the late last minute ceasefire that happened. So I think maybe what we'll do, Jason, let's get to the next slide, because let's talk about kind of like where this started and our positioning and thoughts. And it's been rather tumultuous March for sure, with a lot of uncertainty. But for those that recall, we did point out to people back in January that the sentiment for oil was at a multi-year low. And we were actually very bullish on owning certain oil positions, obviously having no idea that we'd see the conflict with Iran happen between the United States and Iran. But I think if we go through some of the slides again, the idea of this is to kind of walk you through. Everybody's seen the headlines, but I think it's important to kind of see, exactly what the impact has been, but also kind of what our feelings are around oil and oil stocks, and frankly, why we did reduce our positions in them here recently. So here's a quick little chart of Trump's rhetoric. As you can see, very difficult, I think, for anybody to fully guess how this both was going to start, but also how it was going to end. The reality is it's at least ended for the time being. Markets have responded accordingly. They were up significantly yesterday, so were our portfolios. I think the important takeaway here is that there will be an outcome to this, most likely in the coming weeks. The question is, it's what we touched on earlier, is does inflation pick up more than just being a temporary transitory issue? If we go to the next slide, part of the reason for this is going back to the price of oil. So this really messy map shows you how oil moves around the world and how many millions of barrels a day move. Interesting enough, what's not on this map is the fact that it turns out Saudi Arabia has the ability to ship pretty much all their exportable oil out through the Red Sea, and UAE for a certain amount. So, there's also question marks about ultimately how much oil has been sidelined, particularly given that Russia now can sell fully sell oil on the market without any sanctions, at least by the US. But again, you can see why this hits Asia first, moves into Africa, Europe, and then comes over to the United States. Interesting though, US only imports about 10% of their oil from the Middle East. Most of it all comes from Canada. I joked to Jason that it'd be nice if people in the United States realize that we are singularly their most important trading partner, not just for cars and steel, but for oil that fuels those cars. I think we're about 70%, Jason, of US oil imports. So
Yeah. And I think like the interesting point, this little country down here, if they start pumping oil
yes,
more aggressively in the next 3 years, which I think is possible, you have all that oil moving here, which will cut off this entire line. And then the US is completely independent from the Middle East.
okay. All right. So Jason, you want to
Yeah.
kind of relate
So
this back to
why the oil price matters. Typically a doubling in the oil price, and this is this top panel here, shows a year-on-year change in oil prices. Tends to coincide with a US recession. So you see a corresponding drop in US GDP. We did kind of get close during the Russian invasion of Ukraine, possibly tipping the US into slower economic growth. I think one of the things that is a silver lining for the States is at least the energy intensity in the States is much less than it was in the 1970s. So that's a big factor that can make the US a lot more resilient to higher oil prices. And in addition, now the US is a net exporter of oil, so they're not fully reliant on importing oil. Nonetheless, oil prices are set on the global stage, so it's going to Brent prices will increase as well as WTI
well,
prices.
there was a stat I saw that the US consumes the same amount of oil today as they did in the 70s, and the population has tripled.
Yeah, it's
So
amazing.
it just shows you that they're not as dependent. As much as they use a lot of oil, it's not as dependent as they were back then.
Yeah. As Seth was mentioning, like we really don't know how the conflict's going to ultimately end, or maybe it'll be prolonged. But just given the fact that this correlation between oil and economic slowdowns suggests a more defensive positioning from our point of view.
Speaking of positioning, what do we always say? Ultimately, it's earnings that drives share prices. Jason, you want to talk on this? Because I know on our trade note, we touched
Yes,
on.
you can see obviously energy is a big benefactor from higher oil prices. You see an uptick in earnings. It's our experience that that's a one-time windfall gain, and investors tend to look through that. So you will see a pop in energy shares, and you typically see them mean revert. Particularly if there's a policy shift, obviously there'll be a bigger correction in energy. And then other places to hide, you see healthcare, not really dependent on economic growth or on oil prices. Staples tends to be a place to hide, and then technology. I think particularly now it's beating to its own drum with the secular trend in AI, and you can see that earnings growth for tech tends to do well even during oil shocks. And then clearly the consumer is who gets hurt the most, and you see that showing up in stock prices in the consumer discretionary sector. We've seen about 14 weeks of consecutive gains in oil. That's really a record. Historically, investors will recognize those windfall gains as they realize that that big uptick in energy prices and energy shares is not sustainable. And as we've seen, was it this week or last? Sorry, it was this week. We saw oil prices come off about 15% when the ceasefire was announced. So, obviously, we've had some nice gains here. It's kind of nice to lock in something that looks a little unsustainable and move those profits into other parts of the market.
And I think one other thing people forget is that, you think of Canadian oil and gas companies, as much as they benefit from some higher prices, they are limited by how much they can produce, both by their own resources, but also by the sheer logistics that we don't have the pipelines or the shipping capacity just, to meet all that demand that's out there. So, I think it's rather a good title, Strike While the Iron's Hot. The time to own the oil stocks is before this happens, not when it's at the worst of what's happening.
Yeah, and I think this sector will start to look interesting again because they have paid down quite a bit of debt. They are cash flowing. I think once this kind of windfall gain comes out of the sector, we probably will have higher oil prices, so not down the $60 barrel area. So there'll be a bit of risk premium in there, and then at that point, I think energy would be a sector we'd be looking at, and at least kind of looking at a few names to see if it makes sense to add to the portfolio. So the price of oil that you see quoted in the media is the current spot price. This chart shows you the spot price, which is basically oil that is going to be delivered today. And it shows you future prices of oil at the different delivery dates. The reason this chart's important is it shows that, yes, there's a conflict today. There's an immediate shortage of oil because the straits are closed. But if you look out a year, the price of oil is trading around $70 a barrel. So delivery in 6 months from now, 8 months from now, it's kind of trading around where we were before the crisis, which is probably why the market hasn't really reacted that negatively to what's going on in the Middle East. It's basically saying that this is a short-term impact. We think the conflict's going to last a couple months, a couple weeks, but things will largely return back to normal. If this chart was looking a little bit different, that would be a different story.
And I think to add to this is, it's classic old, you'll hear a lot of opinions from different people. But what really matters is where they're putting their money. And clearly, it's showing that, at least for right now, the money's saying that we're going to see lower prices in the future.
Yeah. And you can impress your friends and say, well, the oil price is in backwardation. The higher price is lower. The current price is higher than the future price. So it suggests that oil prices should come down. You can kind of keep that for your next dinner conversation. Past corrections in oil, you can obviously see they're pretty significant. Most recently, this 15% drawdown in the spot price, which happened this week. But as you can see, obviously prices do kind of mean revert once things settle down. And looking at energy shares in Canada, this is a chart from 2021 to current. This is a point where Russia invaded the Ukraine. You can see there was an initial jump in energy shares, and about 4 months later, they peaked out and traded sideways for almost a year and a half or so, or even longer.
Which kind of goes back to, that conflict has been ongoing. But this conflict we expect to end, in the next few weeks or so. But it definitely tells you the money gets all made up front. And the flip end of the scenario is, if oil prices drop significantly, like what we saw in the previous pages, it could mean a more of a correction in the energy sector. Which, again, to Jason's point, we think that the energy stocks would look really appealing to own again.
And this is a fascinating one. So this is the price to earnings multiple of NVIDIA, which is the green line, and the price to earnings multiple of Exxon. And you can see just recently, the two in terms of a price to earnings multiple have just converged. Exxon forward earnings, mid-single digit, and you've got NVIDIA, which is trading around 20 times, growing their earnings 20, 30, 40% per year. So on a price to earnings multiple, including growth, NVIDIA looks extremely cheap.
Yeah. And I think that if we're right about, oil and what we've seen historically, then it makes it even more cheaper compared to something like Exxon, which, right now seems to fully priced in the future.
Kind of taking that multiple contraction further
A bit of
into
a busy chart, folks. So yeah, Jason, use that red
yeah,
pointer.
the broader sector. So the top 10 companies in the S&P 500, we've seen about a three-time multiple contraction. We've seen obviously the contraction in the broader market. But what's interesting here, if you look at earnings expectations, really haven't changed as of yet. And a lot of that earnings you can see is coming from the tech sector. And we don't think the tech sector is going to be driven by oil prices, and it's not going to be driven by a slowdown in consumer spending. There's that secular trend in AI that's driving that. And we're still in mid to early innings in that trend. So technology is starting to look pretty appealing here after this correction. And then on software. Software. This had all to do with
Anthropic.
Thank you, Anthropic.
Claude.
You've seen a huge sell-off in the software names, your Microsofts of the world, and the multiples have just come down significantly. Concerns around AI simply replacing enterprise software, which maybe that happens in 5-10 years, but it's definitely not happening in the next couple of years.
And for those of you that did read the newsletter or would want a copy of it, Jason so kindly wrote out a little story about his own software introduction to Raymond James and how long that took, and just why we didn't think that this would be, something that would dethrone the Microsofts of the world. Oh,
yeah.
Am I doing the one? Oh, that's green. Green for go.
Green for go. So we put little color codes here, so you know which slides we're speaking to. So we've seen a significant rotation underneath the surface of equities. We've seen valuations coming in and converging with some of the energy shares, which makes the growth stocks look pretty appealing. And the Mag 7 have obviously underperformed year to date, but their growth estimates haven't really changed. And if we kind of look at the broader market, we've also seen valuations come down, which makes the market look more appealing, particularly if those earnings estimates continue to hold in.
Blue. Okay, let's just touch on the economic impacts. We've talked about the market, where valuations are at. The thing to keep in mind is they're two different beasts, and they can beat to their own drums. We'll have a slide later on about the TSX versus the Canadian economy. I think that the important economic variables to be paying attention to, which I talked a bit about at the beginning, is inflation. What happens here was already picking up prior to this conflict, and the question is that more sustained? Interest rates in the U.S. right now, they're interest rate neutral in terms of whether there's going to be any cuts this year. That's very different from the beginning of the year, where there was expected to be 2 to 3 cuts. Consumer spending, of course, obviously higher oil prices, as we showed on previous slides, can in fact impact the consumer. And remember, from an economic standpoint, 2/3 of U.S. GDP is driven by the consumer. So we could see a bigger impact in the United States, but we haven't seen it yet. And corporate earnings, which we just walked through. What Jason, it didn't quite show on the slide, was earnings expectations have actually gone up this year overall. I think they're what, 17% growth or something?
Yep.
Yeah. And this is in the face of all the stuff that we've been hearing about for the last couple of months. So, again, at the end of the day, what drives stock prices is earnings, albeit things like inflation, interest rates obviously have a background effect. So, getting to the inflation question. So, I think you can break it down to three scenarios here. One is that it's short-lived, the conflict, and so is the inflation. It's more transitory. I think the second one is obviously it goes on longer, but it's not as severe as maybe some of the media reports have been talking about the potential for damaged infrastructure in the Middle East. And of course, the last one where inflation is persistently sticky and it's hard to bring it down. What this really all means at the end of the day is interest rates are not likely to be cut any further, definitely at this point. And the question is are they raised? And there is a word we threw in there called stagflation. I almost would put that as scenario four, that you get sustained a longer conflict, you get higher inflation that's stickier, and you get a consumer that's more affected, which causes an economic slowdown. And that's not the best scenario. We're nowhere near that, of course, but that is maybe a fourth outcome if I were to add that to these tables here. So again, this chart, what this is demonstrating, thank you for the red pen because I don't have one. Anyways, this is the difference between market expectations and the Fed's long run projections. And it looks at where the Fed is at when it comes to interest rates. And as you can see, it's leveled off here. It was at the beginning of the year, it was looking to come down. The question really is going to be driven by what ultimately happens on the inflation front. And I guess employment to some degree as well, although the last employment reports, things seem to be holding up okay, because the Fed does have that dual mandate of managing inflation and keeping the economy, fully employed. So, K-shaped consumer. Jason, you want to maybe touch on this, because I think this gets into the U.S. I mean, you got the top earners and wealth that are driving a lot of the growth in the economy, and then you got the bottom half that have benefited from a few things, but obviously oil prices hurt them more, particularly at the pump.
Yeah. So the bottom half obviously have seen, both cohorts have seen an uptick in income, which is good. We were expecting the big beautiful bill to, give a little bump to the bottom half of lower consumers. It's estimated that the higher oil prices, if we were just staying around $100 a barrel, it'll probably take about half of the benefits away from the big beautiful bill. So again, it's going to have a higher impact on the lower income consumer.
You want to just touch on what some of those benefits were, because maybe people aren't.
Yeah, like the no tax on tips. There was
no tax on overtime.
No tax on overtime.
No
There was
tax on
quite a bit of
social.
refunds happening in this year's tax refunds. So those, we're going to see a little bit of a bump there this year, which was helping. So half that's going to probably be absorbed by higher oil prices. Most likely won't tip us in a recession unless we get sustainably higher oil prices. But it's really this cohort that is representative of most of the spending in the United States. And this cohort is impacted by the wealth effect. So, if there's a recession or a big pullback in the equity market, that's when they stop spending. And so that's the K-shaped economy. You got two cohorts. One's doing really well because we're benefiting from higher equity prices, and the lower segment is doing better, but obviously not as well as that upper cohort. And then on the earnings front, like Seth said, we're looking to do about 17% EPS growth in 2026. That's up from about 15% at the beginning of the year. So earnings expectations have been moving higher, which is a good thing. And the significant contributor to that is obviously technology. And again, technology is not going to be impacted by oil prices or the consumer, given this secular trend in AI.
bottom line, blue dot, right? Okay, so look, it's, inflation is definitely clouding what central banks are doing with their monetary policy, and whether we see continued rate cuts or, the opposite end of rate hikes. And, in terms of the impact so far of higher oil prices, as Jason laid out, some of that's been mitigated by tax policy or fiscal policy. The BBB is short name for. And again, I think this goes to why we're bullish on technology and healthcare for that matter. It's the earnings, and I think that this AI theme will continue regardless of whatever happens to oil prices. I think on the healthcare front, that's considered a safe sector when things are uncertain. And given that it has such a low sentiment reading, I think we're at a 25-year low right now on it. Valuations are cheap, and people are spending, a vast more of their incomes on healthcare and healthcare related needs. So we think those are two sectors that are going to do quite well. Canada.
Okay. Canadian economy.
Go back to that picture for a second. That was AI created, right? You didn't draw that.
Yes, that was AI.
So that made you pretty productive then.
What is it? What this looks like? It's kind of a combination of Alberta, Toronto downtown, and the
I see
prairies.
the AI bias there. It looks like downtown Toronto.
It does look like it. Maybe because it was generated from an IP in Toronto.
Yeah. Right.
So I think it's really important to point out the fact that the Canadian economy and the TSX are not the same. If you remember back to last year, the TSX was mostly driven by gold stocks. The materials sector was up a lot last year and drove a lot of the TSX return. And I know the Canadian economy is struggling, and I'll show you some of those charts. But the TSX is not the economy. It's driven by external factors like oil prices, like gold prices. The consumer represents a very small portion of the TSX.
Which, interesting enough, when this conflict started, gold has been a pretty massive underperformer.
Yeah, it is.
What worked last year definitely is not working this year.
Yeah. So I think it's interesting to see the surge in Canadian bond yields and also the probability of not a rate cut in Canada, but actually rate hikes. One of the portfolio managers that we use, PIMCO, was forecasting the Bank of Canada would increase rates by 25 basis points this year. The market's now potentially pointing to 2 rate hikes in Canada, as the Bank of Canada focuses more on inflation. And we also seen this kind of uptick in the bond yields. So we have a scenario in Canada where you could have higher rates coming at a time when you have that wall of refinancing happening in the Canadian housing market, which will hit the consumer harder. And you have higher inflation with slower growth. So that's kind of a more stagflationary environment in Canada. Oh, did I miss a slide? Sorry, employment. I did. And then speaking of the employment, like we've seen employment kind of not doing so well in Canada. Both measures, the government measure and private measures, have shown employment moving in the wrong direction in Canada. So yeah, again, stagflationary risks in Canada are greater. The Bank of Canada really hasn't hinted at the fact that they may raise rates, but if inflationary pressures start to build, you'll start to see them kind of jawboning more towards hiking rather than cutting or just holding.
Okay, so known unknowns. We talk about this each time and they shift a little bit. Obviously, the off-ramp, to the military conflict and the impact on inflation and growth, which we've talked about. U.S. midterms, that hasn't even been on the news cycle yet, but I suspect that's going to become a lot of headline stuff soon. given the the polarity, is that a word? um, the polar differences, I think, between Democrats and Republicans. You know, also too, changeover at the Federal Reserve. There's been a lot of talk about who that's going to be and what their viewpoint. Are they more of a hawk or are they more of a bull when it comes to you know, their monetary policies? Looking beyond the SCOTUS tariff rulings, there's a number of things coming before the Supreme Court and continue to be on just some of the policies that the U.S. president has tried to enact and whether they're legal or not. USMCA negotiations, that one I'd actually downgrade. I saw something out today. It seems now, I mean, we can't rely on it, but it seems now that this is going to be a yawner event. It seems that they're going to continue on. I just read something on the Globe Mail with, you know, the status quo with a few nuanced changes for Mexico and Canada. I'm hesitant kind of calling it a yawner just because, I don't know, something happens and all of a sudden, you know, Canada is a focal point of the US's irritation or perceived. And I think the other one, this one's an important one, is the US being a catalyst for reordering of global order. You know, a lot of what we've seen over the last 30 years, 35 years was post-Cold War global order. Came in the 90s. China joined the World Trade Organization, and I think it was 2000 or 2001. A lot of opening of trade and what have you. And, you know, we've now kind of seen the reversal of that in the last year or so when it comes to trade policies, trade agreements, you know, and political agreements such as NATO and stuff. So I'm not sure quite where all this is going to land, but it's definitely something that is creating more, at the very least, distraction, at the more important side, requiring more care and just what sectors we want to be in and companies and stuff. And then, you know, the loonie, right? I mean, it's interesting. Oil prices are up quite a bit, and typically the loonie would be in the 80-cent range. It's not. I think that's definitely an unknown whether the loonie sinks from here because stagflation takes hold in Canada, like Jason was talking about, possibly, or the loonie rallies from here because the USMCA passes and everybody's skinning along again. So that's why we call them known unknowns.
And then just on the midterm elections, we showed this chart in the past. Typically is the weakest week for the mid-year. For the presidential cycle, it's the weakest year in the presidential cycle. So year two, you typically see equity markets kind of moving down towards the summertime and then rallying in Q4. And it's the weakest return of all the 4 years. So that was one of the reasons we thought, you know, be a little more cautious this year because we could have, you know, a weaker period, weaker spell in equities as we head into May, June, July. And then as October and the midterm elections conclude, we could see a rally into year end.
Right. Although this is a market outlook update, we always like to touch on the portfolios and give a quick overview of what we're doing. Those of you that are on the trade alerts, we do, you know, lay out a lot more thought as to what we're buying and selling, why. I thought we'd throw this in there. Actually, Jason, you threw it in there. Do you want to kind of kick it off and just what this checklist is all about?
Yeah, I came across this checklist. I thought it was interesting. I also thought it was worth kind of sharing. You know, keys to managing portfolios and managing, I think, expectations is do not panic when the market is having some trouble. We often see that some of the best days in the market tend to be some around the worst. So if you decide to sell out and go to 100% cash when the market is down, you're going to miss some of the best days. And I think that's important to remember. But nonetheless, you know, we have been starting to raise cash, and we started to do that ahead of the conflict. Thinking about rebalancing your positions, so positions that have become overweight within your portfolio, follow your discipline, take some profit, start to rebalance them. Similar to what we've been doing in the portfolios, we've been reducing equity exposure. We did a bit of a rebalance because our equity exposure was above a certain level, and we took some of it out of equities and moved it to fixed income. Within equities, you can rotate from areas like consumer discretionary that might be hurt by the uncertainty and rotate towards more defensive areas of the market like healthcare. And so in the portfolio, how we've kind of expressed that is we've been reducing our exposure to energy and reallocating to cash, fixed income, and we've been adding to select healthcare and technology names. Holding some dry powder is helpful. If the market were to drop further, we've got some cash we can put to work. Our cash levels in both equity portfolio and fixed income pool are elevated, and we'll use that cash. Either if we get a pullback in the market or we get an all clear and the market can resume its uptrend. I think one simple thing you can kind of monitor is the slope of the 200-day moving average for any market. When it's flat or rolling over, so moving down, that tends to tell you either in a oscillating market if it's flat, or if it's pointing down, we potentially moved into a bear market. So pretty simple to monitor. If it rolls over, starts pointing down, it kind of changes the calculus. We become a little more cautious. And then kind of just taking an audit of your risk tolerance. If you can't take a 20% pullback in the market, typically a average pullback in equity markets is 14-15%. If you can't take that, time to look at maybe adding some more fixed income to your portfolio.
Yeah, and I think too, like this, the reason why I like this is when people ask us, well, what are you guys doing during this crisis that's going on over the last month and a bit? These are all examples of actions of showing active management. We're just not sitting there and not doing anything. And I think that again, Jason kind of put this in the portfolio context somewhat, but I think as an individual investor, obviously you can be thinking about this as well. All right, Kate, select our flagship fund. So in terms of kind of where we're sitting, most of what we own is big, large cap companies. We've gone with a barbell strategy of having defensive names and sectors, while also looking at some of our high conviction sectors such as healthcare and technology that we've talked about. Would love to look at energy when it pulls back further, because as Jason said, I think their balance sheets are going to be looking very good. They'll have good free cash flow, but I think with those things will get cheaper. Again, the focus of this mandate is growth with dividends. And of course, it's actively managed. It's for those of you who've been with us for some time, this has been one of our longer standing portfolios. And it does have an official risk rating, medium, by Raymond James. So the managed income, boring but stable. So this is what we were suggesting for people that can't stomach volatility or going through things like over the last month that we did. Listen, the yield to maturity is, 5 point, well, it was 5.5%. It's a little bit lower now, 5.3. We're positioned well for rate hikes. The duration or average time to maturity of the portfolio is about 3 years. And, it's under respectable return. I tell people the expected return that we shoot for is 4 to 6%. We've averaged 5.5% over the last 12 years. And so, again, it's not no risk. It is low risk, but you can also see that we're not sitting all in high yield junk bonds. It does make up a part of our portfolio, but a lot of what we have is all investment grade, and then over half of it is all A or AAA. That AAA stuff is more government focused. When we talk about things like institutional pricing and what have you, what we're just talking about is, for those of you that are in the pool, before we used to hold it separately managed, we just get better pricing for the third-party managers we use, or when we go to do a trade, we just get a much better pricing because we're doing this all in size. So boring but stable. Jason, do you want to touch on these two here?
Yeah, just some other portfolios within the Cadence lineup, which you may or may not be aware of. We have an income-focused portfolio. It holds Canadian large cap companies. The idea behind this portfolio is to generate above average dividend with a dividend that is growing. It's not focused on capital appreciation. It's really focused on trying to give you a nice, healthy dividend. Currently yields about 6.2%, and consistently growing that dividend. The nice thing about this portfolio recently is investors have gravitated towards it in terms of the names that we're holding, and the portfolio performance has been quite strong. But we're not aiming to have, it's not a growth portfolio. It's not supposed to shoot the lights out. It's supposed to provide income.
Well, and also tax efficient income.
Yes.
The fixed income portfolio, that's mostly interest income, whereas this one is dividend income, which is obviously tax at beneficial rates. And again, this isn't for somebody that's worried about, if a bank drops 30%, they're going to be worried about the bank. It's for somebody who cares about the dividends and the growth of those dividends.
Yeah. And then on the US side, we do have a US balanced, which is about a 70-30 split between fixed income and equities. It essentially holds all the US names that's held in the select portfolio without the Canadian names. So it's a little more concentrated and purely focused on the US. It also has US fixed income. And then there's another portfolio that's just equity only, no fixed income, US names only.
Risk management. What does that mean, Jason?
Okay, so the risk management piece, we've talked about this in the past. It's really understanding the source of the risk and trying to manage it effectively. We can't minimize risk or get rid of risk entirely. It's really about managing risk effectively. And we do that through a number of ways. Obviously, having a diversified portfolio. So, for example, we held energy. It did really well. We took some profits out of energy and we moved it into areas of the market or into some cash that aren't doing so well, like the software names or the technology names. Breaking up our portfolios based on renting versus owning, core or satellite. Names that we rent that are satellite names, we're there for a short term, not a long time. It's very easy for us to get in and out of those names. If it hits a downside target, we're out of the name, it raises cash. We can use that money to allocate to a core name that may have sold off, nothing fundamentally has changed with it, but it looks appealing from a valuation standpoint. The option strategy, we're able to generate 1% to 2% extra return on the on the select pool by writing options, conservative option strategy where we're writing covered calls. So names that we own, we're collecting some premium. Or if we want to buy a name that we don't currently hold, we can write a cash covered put, Micron, to try and generate some additional return.
Sorry, I'm just teasing Jason because we wrote a put, got a really good premium on it, but it may have run away because I think we wanted to buy that.
Happened twice. It looks like it could happen twice. It happened last year. Looks like it might happen again this year. And then obviously asset allocation is key to help smooth out those returns, allocating to fixed income and equities. And risk is ultimately what generates long-term return.
And again, I think the reason why we just want to highlight this is there's a lot of crap in the market about risk management. I say it's crap because it's people that talk in really generic terms and not with specifics, and they certainly don't necessarily follow what they say. These points that we're making, these are all happening in the portfolio on a regular basis. if you are on the trade alert or would like to be on the trade alert, you'll see it. When we do options, we detail, the options that we wrote a call or a put on. If we move money from equities into fixed income because of just being overweight equities a little bit too much, like we did before this conflict started, that's in our trade alert. In terms of the renting versus owning, again, you can see what we're kind of buying and selling. This idea about managing risk is ultimately what generates long-term return. This isn't a new idea. This is what Benjamin Graham taught Warren Buffett. It's an idea that unfortunately in our business is often either overlooked or inappropriately applied. So this is how we're specifically doing it. All right. Bottom line, live your cadence. The setup for 2026 was rosy, was the quotation. I think that we definitely cognizant of the risks and, in terms of the overall portfolio exposure. We do think the bull market is going to continue. It's going to be driven by, in a large part by AI and these big capital projects. And the earnings cycle, you saw that earnings have actually, expectations have ticked up, not down for this year. That being said, we got to watch valuations. When they get high in the late stage of a bull market, that's when the volatility tends to pick up. And, in terms of the Fed easing being a wind in our sails, it's not that we can't make money and the Fed's in a neutral position or possibly hiking. It just means that tailwind may be gone for the time being. K-shaped economy. I think we'll hear more about this, particularly if inflation becomes a bit of a problem, particularly here in Canada. The have and have-nots. The have-nots are going to suffer a lot more than the haves. Mind you, in the US, some of that's being mitigated by tax cuts. Would love to see some here in Canada. I think that would help out everybody. In terms of quality, I think some people get very nervous and scared to lose sleep over it. We see it as opportunity. And as long as we recognize what cycle of this market that we're in, this is where some of the best returns can get made. The late stage bull markets, it's when the final wall of worry has been climbed and everybody's all in. And if you're positioned going into that properly, it can be a very profitable experience, which is what we hope to achieve this year for all you folks. So that kind of wraps up our presentation. If we got questions coming in here, they are anonymous. You can ask us anything. So nobody will know that you're asking a question. Let's see if anything, give us a second here if it's going to come in. Oh, we got a hand raised here. Okay, do you want to ask your question? Whoops. Oh, there we go. Hang on. Jason, can you see what oh, hang on a second. What about gold? I think gold is good. I think people forget though that gold is not the place you want to be when you go through things like what we just went through, right? And we saw that clearly in the market. It's selling off. The other thing people don't realize is that at these prices, a lot of these central banks who are buying up gold are sitting on windfall profits. And so when the U.S. opened up Russia to sell their oil on the markets in U.S. dollars, the Russians have been the biggest seller of gold this year of any central bank. They've sold quite a bit. Turkey's talking about using their gold to do currency swaps. I wouldn't be surprised to see other countries, Venezuela, another one, now that they can, start pumping oil again and what have you, and have U.S. dollars liquidate some of their gold positions. And so it's not that I don't think gold can do well, and it's not that I don't think that it's somewhat of an inflation hedge. It's just not the end all and be all place you want to be, given the market factors, some of the ones I just mentioned. And again, the person asking the question, happy to have a more offline conversation, about that. Okay. What else? Another question coming in here? Okay, yeah. I know we touched on a Canadian dollar, Jason. For the vacationers and stuff, people that are looking to move money back and forth. What's your prediction?
Prediction on the Canadian dollar. Okay, can you tell me if the war is going to continue or not?
It's not going to continue.
Okay, if it's not going to continue, so again, oil prices correcting, the US dollar will sell off, so the Canadian dollar should advance 76 cents.
Okay. All right. All right. Any other questions, folks? Don't be shy. All right. I think we're going to wrap up this. If anybody has, whoops, I think there's another question. Is there? No. Yeah, we're going to wrap this up. Want to thank everybody for joining us today. We will be sending out copies of the slides along with the recording. And if you do have other questions, feel free to email us. We're happy to either email you back or jump on a call and talk about it more. Anyways, thank you very much
Thank you.
for joining us today.